Hi, this is Mani from bsc to nsc.com. So in this video we are going to talk about value investing and what it means and the common misconceptions that many people have. Mostly beginners or amateurs get obsessed with value investing, that they read about some articles about Warren Buffett following value investing, a lot of the wealthy investors who made huge amounts of returns through value investing. So only thing is you should not misunderstand, because whatever Warren Buffett or most of the wealthy and successful investors have followed gets mostly misunderstood by amateurs and beginners. So that's what this video is going to talk about value investing and where you should not go wrong, because I'm sure that 90% of the people just go wrong thinking about value investing. So the basic common misunderstanding, that there are two common misunderstandings that people have, that they think that value investing means investing in companies with lower P/E ratio. So they think that if a company PE ratio is high, it gets talked by even people in the media that the company is expensive, and if the company PE ratio is less, they think that the company is cheap, or the cheap valuations. So that's actually a total misconception, or something that the media does not communicate properly, or even the so-called experts appearing on TV, they totally convey the wrong message to the beginner or an amateur trader. It's actually most likely, if you see companies which have given exceedingly good returns and consistently good returns, and evergreen companies, most of them the PE ratio will be little high. For example, companies like ITC, FMCG sector, pharma sector, most of the private banking sector, all of them will have a PE ratio of about 20. In fact, if you it's an interesting fact that Infosys, which was a 3,000 time multi-bagger since 1995, the PE ratio of Infosys was 60 in 2000 or early 2000 period. But since 2000, it has actually given 10 times returns for the investors or shareholders of Infosys. So, do you think it's a mistake investing in Infosys in 2000 or 2001? That actually is wrong, because Infosys then, way back in 2000, was actually growing at 100% or more every year in revenues and profits. It was a zero debt company. The management was very transparent with its shareholders, and they had clear goals and objectives, and they were achieving always more than what target they had set themselves every year. So even a P/E of 60 is justified if the company has strong brand value, strong management, genuine management, especially not fraudulent. But if you pick if you get a list of companies with low P/E ratio, and if you scan through like 100 companies of them, most of the companies will be having too much of debt, or fraudulent company, or a company where promoter stake is pledged, a company which is running in losses, a company which is not able to consistently show good numbers in revenues and profits. So there'll be at least 10 negatives about a company when its P/E is trading lower. So this is the first misconception that most beginners or amateurs do. They normally shy away from high P/E stocks, and they look into only the low PE stocks, thinking that that is called value investing. So that's a total misconception. The next misconception is, most people, amateurs or beginners, they tend to look into companies whose share price is trading below 100 rupees. So sometimes you tend to think, like, if I buy a company of share price 5 rupees, even with 5,000 rupees I can buy 1,000 shares, and and you feel like extremely happy that you are holding 5,000 shares of a particular company. But in 2008, MRF is a tire company that I'm sure most people know. So they manufacture tire for cars and many other automobiles. So the share price of MRF was 2000 in 2008. So most people will shy away from this stock because if they have 5,000 rupees, they can purchase only 2 shares of MRF. So they will rather tend to invest in companies like Suzlon or Kingfisher Airways, which are actually going down and going towards bankruptcy. The share price might be something like 5 rupees or 10 rupees, and they look to buy 1,000 shares with something like 5,000 or 10,000. But a company like MRF, whose share price was 2,000 in 2008, today the share price is trading close to 20,000. That is because the company has strong brand value, and if you know, MRF was a ambassador for Sachin Tendulkar as well, and they've built up huge brand value in the automobile sector for tire manufacturing, and they have very less debt, and their revenues and profits have consistently grown in the last 10-15 years. So MRF has been an exceedingly good company for long-term investors. So this is another misconception. This is not a misconception created by the media or anybody else. It's just that the default human way of thinking that that you think that a low priced or if the share price is less, then you feel psychologically better holding on to like 1,000 shares. So this is the second misconception. If you avoid these two misconceptions and if you look deeper into true value of long-term investing, then you can actually be a very good investor. So for more details on long-term investing and how to understand the long-term basics of stock market and how to be successful about long-term investing, read my book on art of stock investing. You can log on to bsc2nse.com. The book is very much affordable and costs only 300 rupees and is available for delivery by cash on delivery. So the last point that I wanted to mention here is actually value investing is nothing but investing in fundamentally good companies like MRF or Infosys or Lupin or Asian Paints. There are many fundamentally good companies, actually not many, there will be like at least 50 to 100 companies which are fundamentally good. Buying them close to 200-day EMA levels or 50-day EMA levels when the stock price has come down and is selling at a discount compared to its peak price, that is value investing for me, and that is much better way of investing rather than looking to invest in companies where the management is fraudulent or there's everything wrong about a company. And don't go investing in a company because the PE ratio is less, or because the share price is trading at 5 rupees or 10 rupees, or because you hear some news that the company is going to turn around, they're going to get orders. Don't buy on rumors, don't buy on news. Buy based on the fundamental numbers and strong performance of the company in the past, and believe that they will be able to deliver the same kind of growth in future as well. That's it for now. I'll post more about some interesting topics of investing in more videos to come. Subscribe to our video channel to stay in touch. That's it for now. Thank you. Bye bye.